Good morning, everybody. Welcome to the morning call. I'm Laz on this Friday morning. Unemployment number out this morning, and so far pre-market as of right now, the market seems to like what the numbers are saying as we are trading higher. Like I said, right now in pre-market activity, obviously that's subject to change once the market's open. Let's talk about the market in a broad sense for just a moment before we actually go down and look at some of the charts. Over the last 10 weeks or so, we've seen a lot of volatility in this marketplace. We've seen some aggressive selling. We've also seen some aggressive snapback type of trades where the market has rallied back with a fury after every little micro sell-off. What does that mean? Well, it means there's a lot of indecision in this marketplace. That's what it means. We haven't really had a trend. Although we have seen new lows, we can't really say we are trending lower. And we're going to take a look so we can actually get a better sense of what I'm talking about. So let's go down here to the charts. We're going to look at the spiders. And I'm going to put up a weekly chart. And the reason I like to look at weekly charts is because they provide clarity of thought. We can look at a large sample of data of time, and we can get an idea of what the trend is and why, and what the markets are telling us in a much more macro sense than looking at it on a day-by-day basis. So really interesting scenario here, and this is basically what I'm talking about. This is from the beginning of August. We had that aggressive sell-off into early August, and since that time period, August, September, now we're into October, so 2 months and change, we've seen a lot of red and a lot of green. We've seen a little snap back to the 122s and the spiders, the 1200 area, and we've seen a sell-off as of early this week. We were trading down here in the 108, 107 area, now trading again aggressively back into the 116, 117 area. Volatility, lots of indecision here. Every red is followed by a green, green, red, green, red, green, red, green, red, so on and so forth. And while we are not making new highs and we are not trending up, we certainly aren't making trending down in the sense of a consistent trend like the one you see over here, where we actually have rising MAs and and the market making fresh new highs on a week by week basis, which is really what we'd prefer to see, I think, for most of us. This is volatility. This is for active traders only. This is for traders that are picking and choosing their spots wisely. Tactical buy setups, tactical sell setups, nothing more. I do want to talk about this chart for just another second. I want to just show you a study. I talked about this on the virtual trading floor yesterday. I'm just going to change one of my studies here so I can show it to you. I want to look at the 80-week simple moving average, and that's going to be the black line here. You see this black line, and I have showed this before. So for some of you, this might be new, and for some of you, you may have seen this before. But this is something that I've been watching for a long time. And basically what I'm doing here is I'm going back and I'm going to show you the S&Ps or the spiders on a weekly chart. And this goes back to, if we look here on the chart, on the bottom you can see the time parameters. Over here is the mid-90s, and you can see the bull market of the 90s. And what I want you to really focus on is how this 80-week SMA, simple moving average, really has helped define, in terms of visual imagery, what is a bull market cycle and what is a bear market cycle. When the market is trading above, the 80-week SMA has acted as support at points, and it has defined bull market cycles. When it is below, we have been in bear market cycles. And you can see every few years we've been changing back and forth, cyclical bull, cyclical bear. You can see here in 2007, 2008, you can see we broke the 80-week SMA. We came back up, we retested it in April, and then that's when the market began to free fall. We then snapped back. We got back above that MA, and you can see how it held and acted as support for the last 2 years. And now we are back below. And the reason I bring this up is because the market's gyrating here back below, I think, what is a key indicator for technicians that has helped us define bullish and bearish cycles. Now, how this plays out, I think at this point we need to respect the fact that the market is under this average, which has been a very, very good historical indicator of new bull market and new bear market cycles. And I think we need to watch how this develops over the next few weeks. Right now, we're in a period of chaos. We're in a period of volatility. We're in a period where the market really needs to decide, am I going to ultimately break down, or am I going to snap back, reclaim this bullish territory, and then potentially we'll see what happens from there. To be determined, but for right now, I think you have to lean towards the bearish camp here. I say that only because I have an indicator that tells me that I need to respect it. Let's go and let's look at a daily chart so we can get a much more granular image here of what's going on a day-by-day, more of a short-term path for traders. So I have up the daily chart of the S&Ps, and we're really going to try and do a good, due diligent analysis here. And we have our highs up here from, July. We broke down, and we have what could be, what could be argued as a downtrend line. Obviously, we'll know the power of this downtrend line if and when it gets tested. This morning, that downtrend comes in right around 118 in the spiders, plus or minus. Obviously, trend lines are a little subjective in price. It's more of an area than it is an actual number. So we're going to watch this 118, high 117 area in the spiders to see how price reacts at this level. I think what happens here will determine that next trade. I do think we've seen a very, very nice, powerful snapback. I think we want to watch what happens here. I do think a short-term pullback is in the cards, possibly back to the 111, 112 area. And then down here, you could then potentially launch higher if we can put a higher low in place. So I am speculating a little bit, but I am using my indicators to help me create that roadmap. Obviously, the market will become more bullish if we could put a higher low in place. 3 up days does not mean we are in a new cycle, does not mean a bottom is in, and it does not mean that a new trend has developed. We have 3 days, 3 powerful snapback days after what was some pretty powerful selling. Markets became a little stretched down here. We took out prior highs, probably sucked a lot of the shorts in, selling at new lows. Market trapped them, snapped it back, and now we're back up here into this downtrend line. So I think today could be a very, very interesting and pivotal day for what is to come into early next week. And I think at this point, the best approach is a short-term approach. We don't need to have macro views. We don't need to position ourselves for some larger implosion in the market, nor do we need to position ourselves for some new trendable breakout rally. When that happens, that happens. We'll be there. But I think at this point, it's safe to say we do want to see a short-term pullback here. We've seen a lot of buying come in the last couple days. It would be ideal if we are going to go higher, like I said, to put in some sort of higher low. So we have this low. I would like to see some sort of higher low from which we then get another possible up leg from. That's one scenario. The other scenario is we completely reverse and we come back and make new lows. Anything is possible at this point. So I think it's safe to say let's keep our roadmap very, very simple and very, very short term. We still have lower highs. You can see every time we come up, we seem to make a lower high before turning back down. So let's keep this prior pivot here in place. It's right around 119.50 in the SPYs. So I think that's an area you want to pay attention to if we can continue this leg up. That being said, let's move on from the S&Ps. Let's look at gold. Here's the GLDs. And I know Scott covered this week. We have the sell-off that we saw in gold. Again, new highs. Probably, again, get a lot of buyers up here at new highs. Buyers get trapped, and that's what ensues a major sell-off. Now we are developing this contraction here. You can see a series of overlapping bars, and you can see higher lows in place and lower highs, and it is wedging in its formation. This could pretend to a reversal, or it could be a continuation pattern, and we could see new lows in time. Ideally, I'd like to see a move up here in the short term, but right now gold is a tricky trade. There's not a ton of reason to be there. Wait for a breakout above this, this pattern, this support and resistance level. If you were going to take that trade, there's no reason to be involved with it right here in the middle. So let's see what gold gives us in the days and weeks to come. Moving on to the silver world. Silver has been, not a safe haven. We remember this all too well in May, the vicious sell-off in the SLVs. We did get a retracement trade there. You can see we snapped back about 62% before then resuming the trend, and now we are at new lows again. I do think the selling in silver is probably over for a little while, and I do think you could look to it for a long scenario, but it is not an easy long. This is not by any stretch just set it and forget it. There probably will be lots of gyrations in here. I'd like to see silver hold and continue to maybe trade back up into the mid-30s. I think we could possibly fill this gap right here. So keep an eye on silver for the long side here, as we do have a low that was made. It was retested right here. We put in a low. That low is retested right here, and we've gone a little bit higher. So keep an eye on silver. But again, these are not, trades that I would put a ton of risk in. They're just short-term opportunities. Banks. Let's look at Goldman. Goldman, very much like the S&Ps here. We saw that, that pull off of our declining MAs. Our 21 MA, which is this orange line, you can see firmly in control of the stock every time the stock snaps up into this 21-day moving average, which is declining. It seems to then sell off. So let's watch the price action here as Goldman enters into this, $99 area, $100 area, this 21-period MA, to see how the market reacts at this level. This is a very, very this market right now is for astute technicians only. You need to know your areas of significance in order to step in at the right moments. If you are chasing price higher or chasing price lower, then you are putting yourself at a significant disadvantage because you are taking on more risk. Being a good technician means being able to step in at the right areas where you understand how to mitigate that risk. So that's basically what we're trying to do here, is show you the pockets of areas. Now, at some point, things might change here. If we look at a larger view of Goldman, we are pretty far off on the weekly chart. So this could potentially develop into some sort of larger snapback trade, which wouldn't surprise me all that much, as the banks have seen a pretty aggressive sell-off for the better part of the entire year. Since you can see here in January, early 2011, we've done nothing but just sell off. It's been basically a 10-month sell-off. So it wouldn't surprise me to see a little bit of a reprieve here. Goldman probably could be a decent setup against this week's low. That's right around $84, $85. Any pullback into here, if you could see a pullback into the low 90s, probably would be a good risk-reward scenario for the long side for those of you that like to counter-trend trade, but a calculated one at that nice bottoming tail here. And Goldman, obviously we need to finish the week. And I think most of the banks, if we look across the board, Morgan Stanley bottoming tail, Wells Fargo bottoming tail, not bottoming tail, but a nice base there. Bank of America, another one that I think is interesting for those of you that are looking for a little bit of a reversion to the mean trade. Nice bottoming tail action here. I think Bank of America is not a bad long if that's your cup of tea. But these things are in significant downtrend. So if you are stepping into the banks and you are going to look for this, make sure your expectations are for just a trade, not an investment. Right now, these things are still they're still climbing that wall of worry, and there's still a lot of selling on this tape. Every up move has been sold for as an example here in mid-August, we saw that Warren Buffett news in Bank of America. Had that 2-day jump, and that 2-day jump then ultimately led to new lows again. So respect the trend right here. If you're going to step into the banks from alongside, understand that it's probably just going to be a short term, maybe a multi-week. You might get a month or two of some upside here. Tech. Finish it up with tech. Obviously, the world and the market sort of mourning the loss of a visionary and an icon this week in Steve Jobs. Let's take a look at how the stock reacted. Fairly muted considering the significance of the news, in my opinion. I think the stock, had it was off a couple of dollars yesterday. While the market was strong, the market closed on its highs. Apple put in an intraday reversal here. It snapped into these declining MAs. You can see your 8 and your 21 here, which went bearish right here. We crossed down, ran into that 8-period moving average, and basically fell apart. The market saw some rejection up in that area by the marketplace. So we need to watch how Apple reacts into this area. Right now, to me, this looks more on the bearish side as you have a sell-off and you have a fairly controlled snapback here, tailing down at a declining MA. This is the type of trade that could lead to a retest of this low, this 350 area, or potentially even lower. Let's watch to see how that develops in the days ahead. But I don't think Apple is the same Apple right now. It's not the same Apple that's telling us that it's destined for new highs again. I don't see the marketplace really just diving in and being a buyer there. It was actually the first stock yesterday that broke down. Now, that's just one day, and it doesn't really tell us much about the macro. But for right now, let's stay with that short-term roadmap, as I think that's really where the money is being made. Some others, just quickie in Techland, Amazon. Again, snapping back, 3-day snapback into this 220, low 220s. I'd keep an eye on yesterday's high. We could see a little short-term pullback here in Amazon against this level. You can see this level right up here. It's around 223, 224. Like I said yesterday, some relative weakness here. Although these things didn't really sell off or fall apart, they didn't really have that aggressive buying that we saw in the overall broader markets. Markets closed on their highs. A lot of these tech stocks did not. Baidu, the one that I thought could see some higher prices here. We could trade back into this 125 level in Baidu. Pretty far stretched here, maybe even into this 130 level. So I still think there might be a little gas here in the tank on the Baidu front, which saw some pretty aggressive selling over the last couple of weeks. These trades again they're still loaded with risk. There's a lot of risk in trading some of these high beta tech stocks right now. There's a lot of volatility there. One day can completely turn around the next day. We were strong today. We could be completely weak tomorrow. I mean, it is a one-day course of action here, especially if you're going to trade them. It really is more for the day trader right now than I think anything else. I wouldn't be committing fresh long-term money in any of these stocks at this point. I think the trade still has a lot of risk. That being said, we are off the highs from the 170 area back in August. So it has seen a pretty aggressive sell-off down to 100. I would like to see the stock maybe pull back short-term and then, give us one of those. So don't chase. If you're going to look for longs, make sure you're buying on a pullback or into weakness, short-term weakness. And that about sums it up. Let's keep an eye on what today's market brings us. Again, we're into a downtrend line on the S&Ps. Let's see how the market reacts on this Friday. It's been a pretty good week. We've seen some buying for the better part of Tuesday, Wednesday, and Thursday. Let's see if that can hold into today or if the sellers come back into the mix. As always, I'm Laz. Have a great day trading. A planned trader is a profitable trader, and I'll talk to you shortly on the virtual trading floor.